You are sitting at the dealership, and the finance manager slides the paper across the desk. The monthly payment says $767 for a new car, and the strange part is, it does not shock you. It feels like roughly what you expected, because everyone you know is paying something in that range, and the last few cars you looked at were all hovering near the same number. $767 a month for a car has started to feel normal, and that is exactly the problem. Car payments did not land here by accident. In just a few years, average car prices jumped by about 30%, and the typical required monthly payment climbed by roughly $130 on top of wherever it already was. That kind of shift does not just change what you pay. It changes what you expect to pay, which means the number that would have made you walk away 5 years ago now feels like the baseline. And once a high payment feels normal, you stop questioning it. You stop comparing it to what the car actually cost you in total, and you stop noticing how much of your monthly budget is locked into a single vehicle. I am Sam from Simply Money, and I have spent way too much time studying how car payments became the largest non-housing recurring cost for a lot of households, without anyone treating it like a decision that deserves the same scrutiny as rent. If you are someone who looked at a car payment recently and thought this seems like a lot but also seems like what everyone pays, subscribe, because breaking down that gap between normal and actually affordable is exactly what this channel does. Today, I'm going to walk you through a 3-part framework for seeing the real monthly cost of a car, not just the payment. Let me start with the number the dealership hopes you never calculate. The number the dealership hopes you never calculate is the total. Go back to that $767 payment and ask how many months it runs. The average new car loan term right now is nearly 69 months, which is almost 6 full years. Multiply 767 by 69, and the total commitment is just under $53,000 coming out of your checking account before you even count insurance, maintenance, fuel, or registration. That is not a monthly expense. That is a 6-year financial structure that locks in before you leave the lot, and the reason it does not feel alarming is that the price shock already moved the goalpost. Here's how the goalpost moved. Between the start of 2020 and late 2022, average car prices climbed about 30%. That kind of jump does not just make cars more expensive, it resets what buyers expect to see on the finance screen. Before the shock, the average required monthly auto payment was around $470. By early 2023, it had climbed to about $600, a jump of roughly $130 a month that happened across the entire market in less than 3 years. Once every dealership, every lender, and every listing reflects the higher number, buyers stop comparing the payment to what cars used to cost and start comparing it to what everyone else is paying right now. That is the normalization trap. The baseline shifted, and now a $700 payment feels standard because the market around it says it is. But here's what that shift actually did to households. The bigger payment is not just annoying. Research from the central bank found that the increase in monthly payments alone can explain roughly 40% of the rise in auto loan delinquency over that period, holding other factors constant. That means the payment itself, not job loss, not reckless borrowing, just the size of the monthly obligation, was a major driver of people falling behind. And by the end of 2023, auto loan delinquency rates were running about 60 basis points above where they sat before the pandemic, which tells you the stress did not disappear when the supply crunch eased. The payments that locked in during the shock are still running, and the households carrying them are still absorbing the hit every single month. Picture a commuter who was driving a paid-off sedan. The car needed some repairs, and instead of fixing it, they went to a dealership and rolled into a crossover because the finance office got the monthly payment under a number that felt familiar. The payment is $750 a month for 72 months. That felt manageable because it was close to what coworkers and neighbors were paying. But the household never priced the full cost of owning that vehicle. Insurance alone runs roughly $1,400 to $1,700 a year for many drivers. Add fuel, maintenance, registration, and the depreciation that happens, whether you see a bill for it or not, and one industry estimate puts the real monthly cost of owning a new car closer to $965, not $767. That nearly $200 gap between the loan payment and the actual ownership cost is invisible on the finance screen, but it shows up in the budget every single month as surprise expenses the household did not plan for, because the payment felt like the whole number. Now here's the part that resets how a lot of people think about the used car escape route. You might be thinking, the smart move is to skip the new car entirely and buy used, because a $500 payment is obviously better than a $700 one. That instinct is not wrong on the surface. The average used car payment was about $537 in late 2025, which is more than $200 less per month than the new car average. But the financing tells a different story. The average interest rate on a used car loan was about 11.25%, compared to roughly 6.33% for new. That means the used car charges you nearly double the rate on every dollar you borrow. And if the loan term stretches long, which it often does to keep the monthly number comfortable, the interest cost quietly closes the gap between the two deals. A buyer can choose the used car because the monthly number feels safer and still end up paying more in interest over the life of the loan than they expected, while also driving a vehicle that is closer to its next major repair. The monthly payment made the used car look like the obviously cheaper choice, but total cost told a very different story. And the term length is doing more work than most buyers realize. The average new car loan now runs close to 69 months. That extra length is not a neutral feature. It is how the dealership takes a more expensive car and makes the monthly payment land on a number that does not trigger alarm. A 5-year loan on the same vehicle would produce a much higher monthly payment, and that higher number would force the buyer to actually confront whether the car fits their budget. The longer term removes that confrontation by spreading the same total cost across more months, which makes the decision feel less consequential in the moment while locking the buyer into a longer commitment. Every additional month on the term is another month where that payment sits on your cash flow, blocking savings, emergency coverage, and flexibility. So here is the 3-part framework the opening promised, and it changes depending on where you are in the car decision right now. The first check is total cost, not monthly payment. Multiply the payment by the term, add a realistic estimate for insurance, fuel, and maintenance, and compare that full number to what the car is actually worth to your life. If the total makes you uncomfortable, even though the monthly number did not, the framing was doing the work for you. The second check is term length. If the only way the payment fits your budget is a loan longer than 60 months, that is usually a signal the car is more expensive than your cash flow can support. And the long term is masking that fact by making the monthly slice thinner. The third check is rate and total interest. Before you assume the used car is cheaper, compare the total interest paid on both deals across their full terms, because a lower payment at a much higher rate can cost more over the life of the loan than the bigger payment at the lower rate. If you are shopping right now and the monthly payment feels normal, ask yourself whether it felt normal 5 years ago, because if it did not, the baseline moved, not your budget. If you are already locked into a high payment and the term still has years left, the question is whether refinancing at a shorter term or lower rate would reduce total cost enough to justify the effort, especially if your credit profile has improved since you originally signed. If you are weighing new versus used, do not let the monthly number make the decision for you. Run the total on both, including interest, and let that comparison drive the choice instead. And if you are not buying right now but know the next car decision is coming, the single most valuable thing you can do is figure out what monthly car cost your budget can actually absorb, including insurance and maintenance, before you ever sit down at a dealership where the framing is designed to make you think in payment instead of total. The mechanism is simple. A price shock reset what feels standard. The longer loan term hides the real size of the commitment, and the monthly payment, the only number most buyers ever see, is designed to make you feel like you can afford a car without ever asking what the car actually costs. You are not overspending because you chose a car. You are living inside a system that shows you the slice instead of the whole, and the only way to break the framing is to calculate the total before you agree to the monthly. In the next video, I want to break down what actually happens to your budget when you go from a car payment to no car payment, because that transition is one of the most powerful cash flow shifts a household can make. And most people underestimate how much room it opens up.